pleasure of introducing our keynote speaker for the morning. From one of our state's premier energy companies, Mr. Blue Jenkins, with the keynote, How the Development of Natural Gas in Appalachia is Changing the Dynamics of America's Energy Supply and Driving the Economic Growth in Our Region. Mr. Jenkins is the Executive Vice President, Commercial for EQT Energy, based in Pittsburgh. In his role, he is responsible for EQT's customer-facing natural gas business, including business development for the pipeline and midstream business. He also has oversight of the commercial natural gas operations team, as well as the natural gas trading and asset optimization business. Prior to EQT, he spent more than 13 years with BP's North America Gas and Power business. He began his career at BP as a senior gas accountant at IGI Resources in 1999, and during 2000, IGI Resources became part of BP's Gas and Power team through an acquisition. And I'd ask you to please join me in welcoming our keynote this morning, Mr. Blue Jenkins from EQT.
So thank you. Appreciate the opportunity to be here. I do hope you'll find some interesting things in what I have to share with you this morning. So a couple things. I think it's important. I appreciate the introduction. I do think it's important that you understand a little bit about background of both EQT as well as a bit of my background, because I think it helps answer the question of, so that's fine, but what's your experience, and based on what you do, how should I view some of that data? So I think that's important. So a little bit, as you heard, a little bit of my background. So I ran a couple of different regions of the country for BP, including being their chief operating officer for natural gas for North America. So when we talk about natural gas, I've been doing this a while. And some of the things we'll talk about today, I think, are interesting data points. Some of them lead us to some pretty easy conclusions. And some of them, of course, I think will lead us to, so how do I take advantage of that? And I think that's the question ultimately we'll have to ask ourselves as we go through the conversation today. So if I can figure this out, we're off to a good start. Now, as with any good presentation, my attorneys and my investor relations require me to put this up. I'm not going to ask you to read it, but this way I can say I put it up and you all heard it. Let me summarize this for you. This says, if you have any really hard questions, talk to Greg Hoyer, who's out in the back. Yeah, he's in the back, so talk to Greg. If it's tougher than that, talk to my investor relations guys, and all of the fine print says, these are my opinions. They may or may not agree with EQT. They may or may not actually turn out to be correct, but these are my opinions, and then off we go. So a little bit about EQT that I think is important. We've been around a while. We've been here since 1888. We've been in the region a long time. Originally, the business was founded to bring energy, natural gas and oil, to the local community. So when we talk about growing the region and providing energy for the local region, we've been doing that a while. These type of conversations are critically important to us for the fact that we've been here a long time, we expect to be here a long time, and we tend to focus on what's good for the region is good for all of us, not any of us particularly individual. So we're headquartered in Pittsburgh, as you know. We certainly have significant operations here in West Virginia. We have operations, of course, in Pennsylvania and in Ohio. We've got some operations in Kentucky, and we have a little bit in Texas. More important than perhaps where we're operating and how we're split up is what we do. So, of course, we have an integrated exploration and production company. So we are out finding the natural resources. And then, of course, we have an integrated midstream company. I'll talk to you a little bit about that. And as we talk about infrastructure today, I'll talk to you about some of the projects we have underway, how we think it impacts the region, and what the benefits of that are. But I'm in the unique position to talk to you a bit about, I do run the marketing, trading, and derivatives business for the production company, so I can talk to you about the commodity. I also run the business development and the regulatory business on the pipeline side, so I can talk to you about what we're doing for infrastructure, and hopefully that combined view you'll find a bit beneficial today. We have a significant amount of natural resources, as you well know, in the region. We have 10 trillion cubic feet and 6.3 trillion cubic feet of proved reserves. So when we talk about infrastructure, when we talk about economically developing the resources, it's as important to us as it is to anybody. Okay, so a little bit about our midstream business. You hear less about our midstream business. It trades under a separate ticker symbol, EQM. We started our MLP in 2012, and really that simply was we took our aggregated business and we dropped it into an MLP structure because that seems to be the way you operate assets with fixed revenue streams in today's business environment. So what's the driver for that? That's the best way to operate it from a cash flow perspective. We have about 700 miles of pipeline. We operate another couple hundred miles of FERC pipeline. And then we have about 1,600 miles of gathering systems. So I'll talk to you a little bit about the big lines that you hear about in the news. But as Senator Capito mentioned, it's all of the infrastructure behind that, the 1,600 miles of other infrastructure that feed those systems that provide unique opportunities for some of the other communities around that. And I'll talk to you about how that works. We move about 3.1 billion cubic feet a day across our systems, and we have 32 billion cubic feet of storage, and we've got several projects under development. So when we talk about assets in the region, we have a lot of them, and we feel like we can talk to you intelligently about those. So what are we going to talk about today? Really these three things. So what's happened in shale gas development? I won't spend a lot of time there. You're familiar with the story. But I want you to take some themes on so what can we do regionally to take advantage of that. Then we'll talk about a bit about the infrastructure build-out, and I'll give you some themes that we see. And then, of course, we'll talk about increasing local and regional demand. So hopefully there's a bit of something in here for everyone. But again, as I mentioned, the question I want us to focus on as we talk about the detail today is, so how do we use what we've been given to drive the economic growth of the region? There are tremendous opportunities here. I agree that we are certainly in a challenging cycle. If I put on my producer hat of the business, it's a tough time to be a producer when you sell gas at these price levels. But if I put on my consumer hat, what a tremendous opportunity it is to buy these products, and I'll talk to you about some of the things that I see as opportunities for us in the region. This is a slide I use a lot, and I like this slide because it helps me drive a couple of themes home. We tend to view the U.S. in regions, and we do that because it makes it much simpler to talk about. My split of the regions won't be exactly the same as anybody else's. It does line up with some of the consulting companies, but it gives me some themes that I think are important for us to understand. A couple of those themes. If you look in the Gulf Coast has historically been the supply basin for North America, and we know that. The world has changed. What you look at is you look out across the Gulf Coast. What you'll see is by the end of the decade and beyond, the Gulf Coast is actually a net consuming region. And I think a lot of folks understand that, but I don't think it's fully transpired in the way they think about it yet. The Gulf Coast is no longer able to meet its own demand needs from its native production. It changes the way that energy moves across the grid. Now, if you look at the Northeast was historically a demand region. Now, the solid bars are supply, the striped bars are demand. If you look at where we are today, we clearly produce far more product than we utilize. We have become a net supply region. That creates opportunities and some challenges for us. The important thing that I think we should take away from today is when you look out through the end of the decade and beyond, the Northeast is the single largest supply basin in North America and is forecasted to be that for the foreseeable future. So you have turned the way energy has historically moved and historically flowed in the continent on its head. So gas has historically been produced in the Gulf Coast and flowed north to demand centers. Now the primary demand or the primary supply source is in the north and now flows south to the largest demand center in North America. There are opportunities in there. Let's get a bit more granular. I want to talk about the three states that Senator Capito mentioned, and you'll see in a lot of my references today, talk about the region. I'll give you some specific West Virginia topics since we happen to be in West Virginia today. I think that matters. But as we talk about the region, I will tell you from my perspective, I agree with Senator Capito, and we have to get our heads around. It's less about which state some of those things get invested in, and more about do we get them done in the region, because that tide will lift all boats. But if you look at this, the stacked graphic on the left simply shows on a by-state percentage how much of North American gas production comes out of each state. By the end of this decade, those three states will produce 40% of the total gas supply in the U.S. That's a staggering number. Now, if we look at the graphic on the right, again, using the Gulf of Mexico, not onshore, Texas, Louisiana, but the Gulf of Mexico, the historic Gulf of Mexico supply basin. If you look at that, that is the solid line that starts in the upper left and kind of drifts down towards the lower right. Behind that in the green is the supply growth profile for West Virginia. West Virginia as a state now produces more than the entire Gulf of Mexico from a natural gas supply standpoint, and that's only continued to grow. There must be opportunities for us to have a single state in that region that produces more than the entire Gulf of Mexico. And the question is, what do we do with that? So when we talk about natural gas liquids and NGLs in shorthand, and I apologize if during my presentation I use a bit of industry lingo and I lose you, just raise your hand out. But NGLs, natural gas liquids, so the other stuff that comes out of when you drill a well. And if you look at the overall macro story, the story looks exactly the same. From a North America perspective, we have grown our NGL production base pretty significantly. On this slide, the solid reddish bars across the bottom are the Northeast production, just to give you kind of a reference point. We produce about 20% in this region of what the total U.S. consumes. Now, the biggest consumers in the U.S. are across the Midwest, and they're in the Gulf Coast, and we'll talk about that a little bit. That's not a surprise, I suspect, to anybody in here. That's where the consumption happens. But the bigger piece that I think is important is we've now captured 40% of the total export market globally with North American-produced NGLs. We are a significant component of that global market, which presents new opportunities. It also comes with a few challenges. If we get a bit more granular once again, and I'm not going to talk about the individual products, that's not my point today, but the products that you'll recognize certainly the most. Now, I realize there are a bunch of chemical folks here, so you'll know them all better than I will. But the ones that are the biggest components of the stream are propane in the yellow and ethane in the orange. And you can see the stack up of the 400,000 barrels a day that are produced regionally. What you can also see from the solid or the dotted red line is how much is consumed in West Virginia. So West Virginia consumes about 25% of what's produced regionally. So one of the obvious opportunities is how do we consume more locally? There's plenty of supply, and I'll talk about that theme. Okay, so a recent study from WVU. And there are some themes here that we all recognize that I think require us to maybe view the world slightly different. First of all, is the natural gas has grown 35% year over year for the last 4 years. I don't think that's a surprise probably to anybody in the room. It's a little bit like saying I'm the fastest growing, pick your business, I'm the fastest growing automotive dealer in Charleston. Well, if I started this year and I sold 1 car last year and I sold 5 cars this year, I grew by a factor of 5, so I should be the fastest growing business in town. It doesn't mean I'm the largest business or the most impactful, but I'm simply the fastest growing. So this 35% is a significant number. It does drive, of course, the roughly 10 BCF a day of production we saw from the West Virginia graphic. It's a big number. Now, between now and the end of the decade, it's expected to go 10% per annum. Now that we're a very significant number, that 10% growth year over year is still very, very significant. So that matters. I think one of the biggest things for the state of West Virginia coming out of this study, and again, not my numbers, from WVU, that this is the first year in 2016 where the GDP impact from natural gas will be bigger in the state of West Virginia than it is from coal. I suspect over time that trend continues. And so the question is, how do we capture that? How do we continue to ensure, like anybody's personal portfolio, I suspect, we all have portions of our portfolio we're a bit, what's the right word? We're a bit taken with. We like more than others. But there are times in our portfolio when portions of it outperform the others. And the question is, so how do we rebalance our portfolio? How do we rebalance the regional portfolio to not get rid of what got us here, but to also help us capture of what will take us to the next step? And I think that's the message of what's being talked about here in this particular study. Now, if you're a purchaser, this is the slide that I would take home and show everybody in my particular business. And it is, if you look at the top slide with the green background, it's a pricing graphic going back from 1992 to current for natural gas pricing in Appalachia. So again, using the regional theme, using the 3-state theme in Appalachia, here's what prices have looked like over basically the last decade and a half. If you're a consumer, the circle there, we are at the lowest price level we have seen in that time period, and actually you would have to go back a long ways to see prices lower than where we sit today. As a producer, it causes me a little bit of pain. As a consumer, it makes me smile. The other side of that, when you look at the bottom graphic and you talk about a referential pricing point, so all natural gas is priced in the U.S. from Henry Hub, Louisiana. Why is that? Why is Henry Hub magic? It's a long story, and I won't bore you with the details. It happens to be the pricing point in which storage was traditionally measured in Louisiana, and you had Gulf Coast and that great big story, so whatever. The point you should take away is the highlighted section there. It is the local pricing point here in the region is 40% cheaper than that referential pricing point. So which ones of us that own businesses in the region wouldn't die for the opportunity to say my input costs are 40% lower than my competitors? I think we'd all be pretty happy in that scenario. So the question is, now that the input cost in some of these processes really is 40% lower, how do I capitalize on that? And I realize capitalize is a challenging term. There's a lot of capital needed. I understand that. But the input cost on the usage side is 40% lower in the region. There must be an opportunity there. And as a group of individuals and businesses and legislators, etc., we must figure out how to capitalize on that. What a tremendous opportunity that's created. So this slide, I'll use a little bit of animation because, one, my analysts like doing something that's a bit more interesting than just putting my slides together. So what you have here, and I'll use kind of the eastern half of the U.S., you've got a couple of what I call the T-pipes, Tennessee and TETCO, that connect the Gulf Coast of the U.S. to the northeast U.S. That's what's represented here. What you see in the maroon are the concentration of population centers. So you can see in some cases, when you get to the northeast and you get to the Gulf Coast, it certainly connects those population centers. There are a few along the way, but it's not primarily driven around population centers. What you've got here in the yellow are power generation investments that have been made since those pipelines were put into space. This shouldn't surprise anybody here, I suspect, but what we find is when you get infrastructure in place, it leads to more demand-based development. And these type of investments want a couple of things. Number one is certainty of supply. They want to know that they have access to it, and they want to know it's available, and they want to know they have some backup sources. So when you get the infrastructure in place around natural gas, and I'll also say around NGLs, they're certainly synonymous in this, you get demand-based investment. So you've got to take the first step and get the right baseline of infrastructure involved. Then what you get here on the pink dots are industrial facilities. Industrial facilities want inputs for natural gas, they want inputs for power, and you're going to see them cited along some of these original investments made by natural gas infrastructure. I suspect this isn't news to any of you, but I wanted you to see the story over time that when you make the right first infrastructure step, some of the other things will follow. And the question is, are we willing to take the right steps to get the first baseline infrastructure investment done? Now, I'll click through this quickly. What I wanted, again, was to tie in here. If you happen to be a consumer and you were looking for input products in December of 2016, so you manage your business down the curve, and you know what's going to happen and what you're trying to produce in 2016, again, look at the pricing disparity that exists in Appalachia. You're 80 cents cheaper than the Gulf Coast and more than $1 cheaper than the East Coast. If you were buying inputs on a manufacturing type of process, you would want to buy it in Appalachia. If you get the infrastructure right, you get power investment that comes, you get industrial investment that follows, and currently you have the lowest pricing structure in North America. There are opportunities here, and we have to figure those out. Okay, so a little bit about what's happening in West Virginia and what's going on, and then I'll give you some more granularity. In 2015, a couple of things that I wanted you to know, just what was the state of the union, if you will, in 2015. We had about 3.6 billion cubic feet a day of natural gas production in the state. And the state had about 400,000 a day of usage. So not quite, kind of 9 to 1 in terms of production to usage. And you can see the arrows tell us where the oversupply, if you will, was shipped, where it got utilized. So if you fast forward to 2020, to the end of the decade, our good news is we've doubled our consumption. So we went from 400 to 800,000 a day. That's not a bad step, but look at what we did to production. So we pushed production, we're if you want to be really generous in your rounding, 10 billion cubic feet a day. That's a tremendous number. And what's happening with that? Well, based on the current market environment, you would suggest that all of that is getting shipped out. And where's it going? It's going to the Gulf Coast, and it's going to the Southeast. If you think about the slide I showed you with the solid and striped bars, why is it going there? Because it's where the demand is. So the question is, we know we have the supply, we know we've got some infrastructure being invested, how do we get some of the demand components to stay? Okay, I wanted to give you a hard look. So Shelley gave us some insights onto some of the things that were happening. I want to give you a little deeper look. This is not all of the major projects, but it's most of them. And when you look here, the thing I want you to take away is there's roughly 10 BCF of supply that's projected to be in service by the end of the decade in West Virginia alone. There's certainly much more than that when you use this throughout surrounding states. There's about 14 billion cubic feet of incremental projects to take that supply away. So one of two things will happen. Either the supply will grow more quickly than we're currently forecasting, some of those projects will get scaled back, or it will just take us a while to fill those. But here's some of the things that I think that matter from an economic perspective here. These projects represent $5.7 billion of investment of construction-related investment in the region between now and the end of the decade. It represents 18,000 jobs at its peak, and it represents an ongoing $61 million a year in property taxes. From a state of West Virginia look, this investment is one of the largest singular infrastructure investments in its history. There will be more that follows. I assure you that will happen. But the question is, what do we do regionally to ensure that some of those power plant and some of those demand-based investments follow? You've now got the baseline established, if you will. What are we going to do to ensure that some of that happens? Now, I'll take a moment to be a little bit selfish and talk about two of the projects we have that was represented on the graph. The first one, Ohio Valley Connector, is the short green project you see up there. It's $415 million. It's not a long project. It's 37 miles. But what it does do is it connects that interconnectivity in the region. So we're connecting Mobley, West Virginia to Clarington, Ohio, and the ability to move that product either way into either facility. And so now we've got some increased connectivity in the region so that it doesn't matter per se where the investment follows, but we have the ability to get product from Ohio to West Virginia and vice versa via some of these connectors. Now, the much bigger investment for us is the 300-mile connector, Mountain Valley Pipeline. That's $3.5 billion, again, from the same area of West Virginia, going south through the state, ultimately across southern Virginia into southeast Virginia. Again, a very significant project for us, a very significant economic impact to the region. I won't bore you with a bunch of the details. I'll show you some in a minute. But one of the things that we think we have done somewhat well is when we designed that project, we talked about all the things that we talked about in the previous conversation. What type of struggles are we seeing from FERC? What type of things we knew? This is not the most direct route to build a pipeline. What you would normally do is take a straight line from your receipt to your delivery point. That happened to go through a lot of national forests. We have a competitor who's doing that. We didn't think that was probably the right way to do that. So we went around most of it. We happened to hit 1.7 miles of national forest. That's intentional on our part. And what we do is we hit more counties going through West Virginia, which gives us the opportunity and those counties the opportunity to expand their natural gas supply. And we've had conversations with several individuals and counterparties in those facilities. How do I connect? How do I grow my business? How do I participate in that? That's part of the opportunity that comes from these major investments. Okay, so I want to talk a little bit about the development side for infrastructure. What I did here, this comes from Wood Mackenzie's North American Infrastructure Investment Outlook. I've highlighted the 3 states we're talking about. Again, the themes here are pretty clear. There are about $70 billion of projects in the demand side of the equation that are either firm or probable, so more than likely to happen. If you look at that, $58 billion of that happens to be in the Gulf Coast. And in the entire region we're talking about, it might be, and I use the term might, it might be $3 billion of that. We must figure out how to capture a larger share of that. There are significant dollars being spent. We've got to figure out how to get more of that into our regional coffers. So what do we do to spur that investment? An initial investment is the toughest one, you know that, and it then begets other investments, which are then followed by other folks. But what do you do to break the logjam? And that's the question we have to ask. There are real dollars being spent here, $70 billion of probable projects that are going to likely go, and we have maybe $3 billion of it. Okay, so one of the things that was discussed, I won't spend a lot of time here, In the simplest analysis that we tend to do for presentation purposes, I use what I call our stoplight analysis. So red, yellow, green, you can look at it and know if it's good, indifferent, or bad. And so what I do in the top right, I have what's the Gulf Coast have going for it? Why are they getting all of these infrastructure type of investments? Those are the drivers. Those are the items that drive people to invest in the Gulf Coast. And then I look at the region we're talking about and saying, so what do we have going for us and what are our challenges? We have a significant amount of supply. We've talked about that for the last 15 or 20 minutes here. We're strategically located to serve the eastern-based markets, so that's a very good thing for us. And then we've got some storage. We talked about ethane storage. We've got some storage, but we don't have enough. Now the question is, do you ultimately have to rival the Gulf Coast? The answer to that is no, you don't. But we need more than what we've got. And so what do we do to solve that equation? And then we've got limited interconnectivity. If you can start to solve the storage equation and some of the projects that are on the docket, if you will, get built, you've started to expand the interconnectivity. And then, of course, the ultimate challenge we've got here is there's a very small existing asset base in which to work from. In the Gulf Coast, you've got the largest asset base in the world. Now, do you have to recreate that in the region? No, you don't. But you have to get enough scale that people feel confident investing and that interconnectivity comes. Again, there are a lot of things going for us in the region. There are a couple of real challenges here that we ultimately have to solve. Now, when I talked to you about industrial investment, I talked about pipeline infrastructure investment. I think it's important that we talk about power investment. So again, I took the same three areas, and of the projects that are on the drawing board, there are nearly $20 billion of power plant projects that are on the drawing board. This is how they're proposed. This is where they're proposed to be sited. There's a couple of themes that jump out at me from here. I suspect they're similar to the ones that jump out at you. So there's not a very proportionate sharing of where the projects are sited and where they're proposed to be built. So if I'm a West Virginia-focused individual, whether legislative or I have a business here, whatever it may be, I would want to know what's different. What's different between why is Pennsylvania and Ohio getting 95% of the investment, and why am I getting 5%? Why in $20 billion are there only $600 million cited here? Now, I'm not going to give you the answers. I have some opinions, but I'm not the one investing the power plant dollars, so you need to talk to those folks. But I will tell you there are things that in my mind are fairly easy to fix. I'll give you a couple of examples. Draw parallels if you'd like. When you look back, so I'm in Pittsburgh now. I didn't grow up there, but I've been traveling to Pittsburgh for the better part of a couple of decades. It's a very different city today than it was when I first started traveling there. That didn't happen overnight. That didn't happen because 3 years ago somebody said, we should really revitalize this. We should take advantage of the shift in economic drivers, and we should move away from steel, and we should embrace technology, we should embrace healthcare, and we should embrace energy, and let's start that now. That happened. That's been a decades-long transition, and now what you're seeing is the culmination of all of those many smaller decisions. On a bigger scale, I sit on the Natural Gas Suppliers Association board. We filed an application in the state of New York recently where we shared from a natural gas supplier's viewpoint, public filing. We gave our opinions on what New York State is doing wrong and the reason that folks are reluctant to invest. That got some headline news, as you might expect, from the Supply Association. What was more interesting is we got a phone call in from one of the political reporters in Albany. And in that conversation, just kind of talked through some of the things that we were seeing. And we recognize everybody's got an agenda, and that's fine. You got to work through those. But the interesting part of the conversation to me was the part that came from this reporter who said, well, at least you're public about your opinion on why you're reluctant to invest in the state. This reporter said, I have a significant amount of demand-based conversations who won't be as public as you are, but they're also not willing to invest in the state because they're not comfortable with the environment. And so when you restrict one portion of your process fairly tightly, it does put a bit of a damper on other parts of the process. So for the region, the question is, what are we doing right and how do we do more of it? And what things are keeping folks from investing in the various segments of the business or the various segments of the states represented here? And how do we address those? What can we learn from the things around us? Again, and I'll use the theme, it's less about how much of the pie can I get. What we should be thinking about regionally is, how do I make the pie bigger, and how do I get my share of the larger pie? And so when you talk about infrastructure and the investments that build on one another, you've got to get it moving, and then the inertia works in your favor. Right now, the inertia is not working in our favor. Okay, this is the one I wanted you to read in detail. No, I'm kidding. What I have here, this is the type of data we look at when we make infrastructure investments. I'm not going to read this to you. It's all available through a company called FTI Consulting, but it is. And you have this data available to you whether you're on the legislative side or the manufacturing association side or the individual business owner side. And it is, what are the knock-on effects of my investment decisions? And this report was a county-by-county assessment for us on our Mountain Valley investment project. So for our $3.5 billion, what are the positive drivers that occur? And of course, we took this report and made some tweaks to the process, but the amount of jobs we're creating, the amount of revenue we're going to spend in the construction, the amount of ongoing revenue, all of the type of things that help drive what we know from reports like this. If you can get the investment infrastructure decisions made in the state, your long-term run rate improves greatly. Okay, so really, what are the takeaways? We are now the supply hub for the U.S. That's no longer, you don't have to prove that. In 2007, I was running the Northeast and Mid-Atlantic for British Petroleum. And I was at a utility conference. And one of the individuals there, and I'll leave him nameless, said, I'll never buy natural gas in Appalachia because it's not as reliable, and I'm not sure there's enough of it. And so I'll buy all of my gas out of the Gulf Coast, and I'll ship it all the way up the eastern seaboard because that's what I'm comfortable in. We don't have to do that debate anymore. We don't have to convince them there's plenty of supply here. So check, we got that one done. Pipeline and processing infrastructure is critical when you talk about liquids, etc. And we've got a really good start on that. We've got a really good baseline of infrastructure. And that infrastructure will then bring more investment, but we have to figure out how to facilitate that. What you've seen over the last handful of years are the producing side of the equation pushing for those demand-based investments so they could get their product out. Now what you should expect to come, and what we should figure out how to capture, is you should get the demand-based side of the equation to reach back and to connect and to make their side of the investments. Now we have seen that in our Mountain Valley project. I'll give you an example. We started that project by pushing from a producer standpoint, and we brought our business partner on board, NextEra, who's ultimately the largest, until some other mergers happen, currently the largest buyer of natural gas in the U.S. based on their Florida power and light facilities. Well, they can't get to Florida from Appalachia, and they knew that. But they knew over time, if they got involved in the process, they would figure out how to make those connections work. They were very thoughtful. And now we have the demand-based Con Edison of New York now reaches back into Appalachia. Washington Gas Light out of D.C. is now reaching back into Appalachia. Roanoke Gas Company in Southern Virginia is now reaching back in the project Appalachia. The demand investments will come, but you've got to step out and get the baseline infrastructure investments done. So there are a bunch of opportunities, I think, for industrial and for power-related type of opportunities. But as a region and as the various leaders sitting in this room, it's going to take a collective effort to pull that off. And understand that the world is shifting around us. Our portfolio is changing. It will continue to change. How do you take advantage of the opportunities that are presented now and take those for a long run test? And then make sure we're thoughtful and we're keep our ear to the ground, and that we encourage and support the other investments that will come to see which parts of that portfolio will ultimately grow and be the next 100 years, if you will, of the driver. So anyway, I think there's a tremendous opportunity. I think it's one of the most fascinating times to be in the region. I left a Fortune 5 company in British Petroleum to come to EQT because when I looked at the region several years ago, and I ran it for a while for BP, so I had a deeper insight maybe than most. And I thought, this region of the country is changing, and it's changing so quickly and so dynamically that being involved with a company in the region is the opportunity of a lifetime, and I think that's still true. We're in a bit of a downturn if you happen to be on the sales side of it, if you happen to be on the buy side of the equation. This is the opportunity of a lifetime to make the right investments and infrastructure decisions to set you up for a very long run. So I think it's a fascinating time to be in the business. Thank you for having me.